Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. Earnings season is one of the most exciting times for investors. It's when publicly traded companies report their latest quarterly performance to shareholders, and there's often no shortage of fireworks. Stocks may swing wildly on the back of an earnings report, and that can present buying and selling opportunities for savvy investors. In this episode, we'll hear how one experienced investor spots undervalued stocks during earnings season. From sifting through financial statements, to dissecting management conference calls, to reading the insider tea leaves and more. Plus, stick around till the end of our conversation and we'll hear about the lessons that he's learned from some of his biggest hits and misses. Joining us is Philip MacKellar, General Manager of Contra the Herd Investment Newsletter. Philip, welcome to the show. It's great to have you here with us.
Well, thank you very much for having me.
All right. Well, we're going to start off. I warned you earlier on, we're going to start off with the lightning round. I hope, is that okay? I'm going to fire off some questions to you really quickly and answer them as fast as you can. Does that sound good?
That sounds good. Fire away.
Fire away. Okay. So you don't have to go super fast, but yeah, we'll go at them pretty quick here. So you have 7 financial rules that you live by. Which one has been the most impactful for you?
Well, yeah, like you say, there are 7. I found that they are all important at different times. So the ones I have are tracking your spending, having savings, setting goals, maintaining an emergency fund, avoiding debt or eliminating it, maximizing your income, and investing. So all 7 of those are very important. And I found before I was a homeowner, saving for that house that I and my partner eventually bought was important. And then now that we have a house, eliminating the debt is important. And then when I was starting out, fresh out of university, didn't know how much I was saving, that tracking of the spending was really important. So all of them are important, but it oscillates over time as to which one is more or less important versus the others.
I was putting you on the spot there. It's kind of almost like picking a favorite child. It's impossible to do, right?
That's right. Yeah.
Yeah. All right. So you've managed to turn your passion for investing into a full-time job with the team at Contra the Herd Investment Newsletter. How did you make that happen?
Well, I was in my final year at university in 2010, and I was watching BNN regularly. And one morning I was making breakfast, and Benj Gallender came on the program, and I was listening to it in the background. And within 5 minutes, I was hooked. So I hustled my breakfast down and just watched it, and then watched a whole bunch of his historic content, and then read his books. And after reading his books, I reached out to him, and we started a conversation, and then eventually to Toronto and working for him part-time before working for him full-time starting in 2014. So it was a cool experience, reaching out to somebody who I just kind of seen on TV, and then having it turn into a job was excellent. So yeah, if there are young people out there wondering how to go about working for somebody they really want to work for, go and contact them, reach out, ask good questions, be polite, be persistent, and hopefully good things can happen for you.
Oh, wow, that's interesting. Because he had you at Contra.
Yeah.
He caught you right off the bat.
Yeah.
So speaking of that term, Contra, so you're now a contrarian investor like the rest of the Contra guys. Can you explain what contrarian investing is and why you like it so much?
Yeah, I really like it because very few other people do it. So that means that there's some structural advantage built into it. As for what it is, we are looking for things that are genuinely beaten down, things that are off their highs by 30 or 40 or 50%. We are not looking at, say, a high flying tech stock that has had a 5% or 10% pullback or something like that. We are not looking at that. We are looking for those genuine contrary opportunities, which are so beaten up and so disliked that very few investors want to touch them. And then once we've found those companies, We want to find companies that can survive the rough patch they're going through, regress to the mean, and occasionally companies that can actually grow longer term. So that's in a nutshell what we do, and it's quite a bit different from what a lot of other investors do.
Yeah, I like it. I like that idea of going against the herd. So, what are some of the top
Mm-hmm.
factors you like to see in a company that suggest it could be an investment with contrarian potential?
Yeah, well, the first thing is the company beaten down? Is it unwanted? Are analysts hating it for whatever reason? That is the place to start. And that often expresses itself with a falling share price and low valuations. Not always, but often that's the case. From there, what you want to do is you want to avoid the companies that are going to go bankrupt or just going to go nowhere for years. So from there, we look very closely at financials. We try to get a sense of how much dilution there has been, because sometimes there's just been so much dilution, there's no point in looking at it. And then in terms of the financials, we really want to know if insiders are aligned with us, whether the people that are running the company are acting in our interests, not just in their interests. So that's very important. And that often expresses itself through insiders buying up shares, not getting options or stock based compensation or something like that, but actually like going out, taking 50 grand out of their bank account and putting it in the company. That's the sort of thing we really like to see. Doesn't always happen, but it's nice. And then the key thing with any turnaround is you have to have a plan. So if a corporation is in a rough spot and it doesn't have a turnaround plan, well, that's useless. That means they're going to be treading water for a long time. So a company has to have all those ingredients plus a turnaround plan.
All right, fascinating. Has there been a time? So, this is a chance for you to brag a little bit. Has there been a time where you were right about a contrarian call that nobody else supported?
Um, well, I don't always get it right. Sometimes companies that I buy go down or go sideways. But the companies that do go up and do well in my portfolio, the time that I buy them, very few of them are in a position where other analysts like them, other investors like them. It would be really unusual for me to start accumulating shares in a company where a lot of other investors were also interested. So
Did we lose?
I can think way back in the day, 2017, 18, I invested in Cameco, the big uranium company in Saskatchewan. And at the time, they were facing litigation and they had massive tax disputes with the CRA worth billions, like $2 or $3 billion. It was huge. The IRA, or IRS in the US was after them too. Japan was shuttering nuclear reactors. Mines were being closed. They were trying to mop up supply on the secondary market. They weren't even mining for a lot of that period. So nobody liked Cameco in 2017 through 2020. And it was during that period that I started accumulating shares. And it worked out very, very well. I've sold the position since then. But that's the kind of thing I like to do. And I also like it when markets are beaten up. So in March of 2020, when the pandemic was just hitting the public lexicon and everything was falling apart, markets were falling so fast. And in March of that year, I was just buying stocks every single week, just slowly plugging away. And it felt like I was the only person still in the fight. I mean, everyone else had fled. So I like that, and those are two examples of how it's good to do something that no one else is doing.
That's really interesting. And, we're going to get into that a little bit further. It sounds like you found a few diamonds in the rough, and I know you're going to talk about that today. So, let's get down to that. Let's get down into the heart of our conversation, spotting opportunities
Sure.
during earnings season. So, I have a few questions for you
Mhm.
there. First off, I know I touched on it in the intro, but what is earnings season and when does it occur?
Well, it's just when a company reports its latest quarterly results, really. Oftentimes, if a company has a regular cycle, so its fiscal calendar follows the actual yearly calendar, their earnings will come out 2 or 3 weeks after the close of each quarter, or maybe a month after if they're a smaller company. And that's when they do it. They're pretty good times of year to be paying attention. But I should also say there are oddball companies out there that have irregular earnings cycles. Either their year end falls not on December 31st, but some other date. So it means that there are some companies that report at odd times of the year. I have a company I own that is reporting this evening, for example. So most of them are quite aligned with the calendar year, but there are some that aren't.
Okay. Would you say that your approach to earning season, would you approach it differently as a contrarian investor than, say, a buy and hold investor?
Um, I would say that it's different insofar that I'm not looking for something that's doing well necessarily when I'm building a watch list. That I would say is quite different. A lot of investors will be looking for things that are doing great and loading up on those names, and that's just not what we do. As for the actual process of going through the earnings, I don't know how different it would be, but I would like to think it's more rigorous than what most investors do. My goal when I'm reading through an earnings report or when a company releases its earnings is not to miss critical information. That's my goal. And I'm always looking at companies in my portfolio or on my watch list, but earnings really is a time where I do a cross check. So I'll go through the news on their corporate website. I'll visit the SEC website or the OSC website and I'll look through all the filings that have been made there, because sometimes companies don't release what I consider to be material information in their newsfeed. Say if investors voted down a stock compensation package or something. But by and large, the corporate press uh, website is pretty good. Then I want to read analyst reports. I want to go through all the material information and update my Excel sheets. I want to review the press release, the presentation, the MD&A or the 10Q if it's a US company. And then I want to read the transcript. And then after I've done all those things, I really like to look through, see what insiders have been doing, see what the short interest is, see if big investors have been adding to their positions or selling them. And by the time I've completed all those steps, I usually have a pretty good sense of what's going on. I may have still missed something important, but the odds have reduced quite significantly by the time I've gone through all those steps. So it's rigorous and it's clunky, and that's just my personal process.
All right. Well, sounds like it is. Yeah, it's a bit of a in-depth process for sure. I like that you elaborated on some of the sources that you're going to get that information from. What are those? You said some critical pieces of information. What are the key pieces of information that you're looking for during earnings season that can help you spot like a potentially undervalued stock?
Yeah, well, a big thing is comparing their results to management's prior guidance. So if at the start of the year management said we were going to earn $1 per share, and we're looking at the June quarter and they've only achieved 40 cents year to date, you might think, okay, well, they're not going to hit that dollar unless there's some big catch up in the back half of the year. So watching what management says versus what actually transpires is very important. And hand in hand with that, the analyst community will often give a range of expectations or give you a sense of what they expect. So I like to see if a company is hitting management or hitting analyst expectations or whether they're not. So those are the first two big things I look at. I also look for if it's a turnaround plan or a turnaround story. Again, I'm looking at their turnaround plan. Are they making progress towards fulfilling all the steps in their turnaround plan? Is their turnaround plan changing? Is that invalidating the thesis I thought I had for that stock? But that's really key. So in addition to looking at all the numbers, looking at the guidance, looking at the analyst expectations, just understanding how they are working through the turnaround and whether they're on track. Those are really big things. And that's when something like a presentation or a transcript comes in handy, because that's when they'll really talk about their strategy and whether they're meeting their goals.
All right, that's some great insight. So you and I both know, Philip, that stocks can move a lot on their earnings results, which can present potential buying and selling opportunities or trading opportunities. In your experience, can buying or selling stocks either before or after their quarterly reports be a good way to boost returns?
Yeah, I would say yes to both. You can have good results by buying prior to the earnings if you have a really good sense of what's going to happen and you think the market's wrong, which is difficult but possible. And after a company releases its earnings, often what I found, if the company does well, the shares will rally and then they'll taper off for maybe 4 or 5 days, but then they'll continue their upward trend. If they are good results for the next quarter, they'll probably go in that upward trend. And then same is true if the stock is falling. If the stock had bad quarterly numbers, just a bad outlook, then the stock will fall, then it will recover slightly and drift lower again. So buying before or after those events can be a good way to just help calibrate the return quite a bit. So I do try and do that sometimes, and occasionally it's worked out quite well, and occasionally it hasn't. But that's the way it generally works.
Well, that's the way it goes. One thing that I know that I've experienced that's extremely frustrating is, and I'm sure you've had it happen and our audience has had it happen, where a company will report positive quarterly results, but the stock will drop. So, or they'll report
Mm-hmm.
negative results, but the stock will rise. Why do you think that
Yeah.
is?
Often when that happens, it's because the information is already priced in. The whole buy on the rumor, sell the news on the news, that kind of pithy phrase, there's a lot to that phrase. So I think that's often what's happening there. If it's a stock that's in the news because they've been doing great things and customers like their products, then people will be expecting really good results when they come out. And sure enough, really good results come out, but maybe they're not quite as good as what the investment community was anticipating. So that can explain why that happens. Another thing I sometimes see is if the earnings are good, they hit their numbers, but the outlook is bad. That can change things, and then vice versa. So yeah, I would say by and large, the information already being priced in is a big part of that, and then you have these kind of discrepancies between good earnings and a bad outlook, or bad earnings and a good outlook.
All right. Is there any other techniques or methods you would use to take advantage of that at all, Philip? Like on this idea, I know there's a lot of people that have probably experienced that where, the stock is dropping even though there's been good earnings. Is there any way you look at it to approach those situations?
Well, if a stock did exactly what you were just describing, I'd be inclined to go and buy it. If a company has reported good earnings and the outlook is reasonable and the stock's falling, I'll be certainly more interested in going and buying that than I would be otherwise. And then sometimes on the flip side, if the results were okay to bad, but the stock did well, if it hung in there for whatever reason and it was near my sell target or at my sell target, I would think about trimming the position and scaling back, or even cutting the position entirely. So that's how I would think about that, and that's what I've done historically anyway. I would also point out occasionally you'll find examples where the analyst community is awful at predicting the earnings of a company. For whatever reason, they just get it wrong. And they don't get it wrong by like 2 cents or something like that. They get it wrong by like 20 or 30 cents on earnings of, say, a dollar. So occasionally you'll see that, and it can be fun to try and take advantage of that too.
Oh, nice, nice. Coming into earning season, so this I use like a sports analogy. This be like going into the playoffs for you. You're coming into the earnings time frame. Is there a way like this can be a really busy time with a lot happening all at once? What sort of preparation do you do ahead of earnings season so that you're ready to make your moves?
So when it comes to making sure I know when every company is publishing their earnings, I will have all of that in my agenda or my calendar, so I know which days which companies will be reporting earnings. So I'll be prepared for each company on my watch list or each company that I own, and I think that's quite important because you want to. When the earnings break, you want to at least take a glance. If you have to go and run an errand or you're going somewhere, you still want to at least look at them just to see what they're like and then come back to them later. Then if I don't have anything else on, I'll just dig into it. So that step-by-step process I mentioned earlier, I'll go and look at that. I'll go and read through the press release, the presentation, the transcript, the 10Q. I'll go and do all of that, and then I'll just, if there's 4 companies in a day, I might not get to all 4. And what I do at that point is I prioritize. And if a company has done really badly, that will be the first one I look at. And if a company is doing really well, that will be the second one I look at. And then if one's just kind of mediocre, that'll be the last one I look at. So occasionally you have to prioritize. Um, and that's what I'll do when earnings season really picks up.
All right, that's how you get ready. I like it. So let's dig into some specifics on. So companies will report their quarterly earnings through the big 3 statements, right? We have the balance sheet, the cash flow statement, and the income statement. So all 3 of these can offer clues about their investment potential. Let's start with the income statement. And what trends are you looking for in there?
Well, having revenues go up is the first thing that comes to my mind. In general, you want your companies to be growing or at least improving. If it's a turnaround situation, often the revenues will have been going down for a while. So you want to see those stabilizing if there are companies on your watch list. Investing in a company without stable revenues as a turnaround candidate is a little risky for sure. It can work out, but it's a little risky. Then oftentimes what I want to look at after that is I want to see the gross margins improve. That's often a first sign of a turnaround strategy. And then it filters down into positive operating income and eventually positive net income too. Companies that are on my watch list don't always have positive operating income when they land there, but I do like to see that if I'm getting more serious about the name. 2 other things I just mentioned. Occasionally, what I like to look at is the SG&A. Sometimes companies can have really bloated SG&A. So I want to see if they're trying to make efforts to reduce that line item. And then with R&D, R&D is a kind of funny one because say if you buy a real estate asset, you amortize that over 30 years, but your R&D gets expensed, but your R&D should produce future income just like your real estate asset. So there's some accounting I wouldn't say problems, just something to be aware of there. So I like to kind of just make a rough hand amortization of the R&D in my head when I'm looking at companies, just to try and make more of an apple to apples comparison. And then after I look at all those things, another big thing to look at is just the share count. Is the share count declining or increasing? Because dilution can really hurt you if it's happening at a rate faster than sales and earnings are increasing.
All right. Well, I know we love our acronyms in the financial industry. One I caught, just to make sure our audience understands what it is, and another term I want you to kind of see if you can unpack a little bit too, Philip, is so the first one is SG&A. Can you tell us what that is? And then the second one, can you explain, just I caught the idea of dilution. Just make sure our audience knows what that means as well.
Yeah. So say SG&A is sales, general, and administrative expenses. So your cost of goods sold is what it actually costs you to make the product. So the manufacturing processes that go into building whatever you're building. But the SG&A is all the costs associated with marketing that product, selling that product, and then hiring the corporate office to run your business. So it's the kind of secondary layer of expenses, and it's quite important. And you can see the consequences of having an overpaid executive team in that line item, or a marketing budget that doesn't make sense, or something like that. So that's what SG&A is, and I think it's quite important to look at. And then your second one was about dilution. So dilution just means the number of shares that the company has outstanding. So if a company has 1 million shares outstanding and they want to raise money, they might double their share count, which means that you as an investor will now own half of the earnings that you would otherwise. And unless the company is doing something really impressive with that share issuance, you'll end up paying the price. So instead of, say, making $1 per share, well, now you'll be making 50 cents per share. I mean, if they can double their earnings, great. But if they can't, you'll just end up with half of what you had previously. So that's really not a good situation. And in some cases, you see this a lot in biotech, in small tech, and in small mining companies. they dilute shareholders a lot, and it just really hurts. It's just very hard for a shareholder to break even when that happens, and occasionally you'll get a share consolidation as a result, or you'll be wiped out in one way or another.
Oh, no, thanks for clarifying that, Philip. I know one I've even heard recently too, just to add to the list is, that SG&A. If you do see a really major effort on a company to, expand their selling and general and admin expenses to support maybe declining revenues, and if it doesn't work, if revenues are still going down, then that's a big kind of a red flag as well. Is that something you've used before?
Certainly. Yeah, definitely. Yeah, that's a very good point.
All right. Yes, one I just heard the other day that made a lot of sense. So
Yeah.
let's jump from the income statement to the balance sheet. And what do you want to see here that can signal a stock may have potential?
Yeah, the balance sheet is like I think it's an important statement to determine if it has staying power, if it can make it through its current trouble. So, as an investor looking at turnarounds and looking at beaten up companies, this is really the first thing we look at. Once we have a watch list of companies that are down by 30% or more, now we're looking at the balance sheet. Does this company have the wherewithal to stay in the game long enough for their turnaround to take shape? So what we really like to see is a good cash amount of cash on hand, a good current ratio, and good working capital. And then on the flip side of that, we want to see, or at least reducing it, trying to make it lower, trying to pay it off, trying to extend maturities or reduce interest rates, or something that suggests to us that their debt load isn't going to cripple them or kill them. So that's quite important. I also really like it when a company it has uh, more receivables coming in than payables going out. If they don't have that ratio right, there's something squiffy going on. And same with the current ratio. If you have fewer current assets than you have current liabilities, your cash flows better be pretty good to make up that difference. So that's something that I really like to see. And then something that we may have a chance to talk about later is goodwill. Goodwill can be a great thing if a company is buying up peers at attractive prices and integrating them well and growing them. But it can also really hurt if goodwill is added without adding value to the company. Eventually, it will be written off, and that write-off process can be very painful. So those are some of the big things I look for when I'm assessing a company and looking at it. Either I own it and I want to make sure they're still okay, or it's on the watch list and I want to see how it's doing.
All right, that's some great stuff. Let's move on to it's my personal favorite, the cash flow statement. What do you focus on here that helps you find potentially undervalued stocks?
Yeah, cash flow is good. Occasionally, a company can report losses, but report operating cash flow and free cash flow. And that's actually quite nice to see from a turnaround standpoint, because often the cash flow is what really matters because you want to be adding cash to the balance sheet and then funding your operations. So I like to look at the cash flow from operation line. That's quite important. If it's a big tech company, I'll also look at stock-based compensation because occasionally that is an issue if they're just paying out tons and tons to their employees and their executives. Um, and then I want to make sure that the dividend is sustainable and safe and that it's not going to be cut. So that's quite an important line for me. CapEx is also important. How much is the company spending in CapEx? Some companies you have to spend so much. Telecoms come to mind. Telecoms, you're on a constant treadmill. You're having to invest more and more in your infrastructure, and it just costs a lot. Whereas other companies, like big tech companies, for example, maybe not nowadays because they're investing so much in AI, but historically they haven't invested a lot in capex, and um, that's a very big difference to take into consideration. And then the cash flow statement will also show you how many shares or how much is being raised in equity and how much is being raised in debt and how much is being taken away in equity or taken away in debt. And that's quite important. Again, talking about the balance sheet previously, you want to see debt going down if you're looking at a turnaround that's in a tough spot. And the cash flow statement will succinctly say how much debt is being added to a balance sheet or subtracted from the balance sheet. So I quite like it for that reason.
Well, that's some great information on the earnings reports themselves. Thanks for sharing that, Philip. I wanted to shift gears a little bit. We'll get to another key part of earnings season, which is the conference calls, in which management, speaks with investors and
Mm.
analysts. What are you listening for there that can help you spot undervalued stocks?
Yeah, so usually the conference call stuff starts out by just fleshing out what they've already said in their presentation or their press release. So it's not super insightful, but it sometimes can be because they're able to elaborate on, say, a specific target or something like that. So it can be useful for that. Where I find it really useful is when the question and answer period comes in, because an analyst can ask questions about all aspects of the business or talk about things that management may not want to talk about. So that is very important. That's very good. If the analyst is a good analyst, they'll ask pertinent questions around pressure points facing the business. So I really want to see that back and forth. I want to see what does the analyst ask, and then how does management answer that, and that can give me clues as to is the guidance actually good guidance? Are the analysts being too hard on them or not? And also, is the guidance maybe an undershoot? Is the business actually improving more than the management team is letting on? And occasionally, you can glean insights into that by reading the transcript. I used to actually listen to the conference call, but I don't do that so much anymore just because it's so time consuming and you can read faster than you can listen, even when it's on double speed or whatever. So, yeah, generally these days I'm just reading through the conference call transcripts.
Yeah, none of us have time for all that. I agree with you there. That could be
Yeah.
very time consuming. To follow up on that, what would be some underrated pieces of information that you can glean from the earnings season that you found may help you spot undervalued stocks and investment opportunities?
Yeah, it's often something that management doesn't talk about, but it's the insider activity going on in the company. So, reading through all the information that we've already talked about today is really important. But then looking at the insider ownership is really important too, and seeing what management is doing, and again what the directors are doing. So management often can't trade directly before or after an earnings release. There's a little blackout period, but in the 2 or 3 months prior to earnings, they can do that. So looking and seeing whether they're buying, say, a month out before the earnings happens or selling a month out, that can be quite informative. And especially with a turnaround company, if a company has a great plan and they have all their pieces in place, but management isn't buying, I get a little wary of that. And same if I'm owning a company. But on the flip side, if everything's going well and management has recently ponied up some money and they're putting it in their shares, that's quite a bullish signal. So um, I think that's, I don't know if it's underrated. You asked for some underrated information, but I think that's very important. So I would just like to highlight that as something that investors should look for.
No, that's great. That's great information. It may be underrated to us. Like that may be something myself or our audience haven't heard of. So thanks for sharing that. So companies sometimes do try to hide or minimize like if they have poor quarterly results. What are some of those tricks that investors should watch out for, when they're evaluating companies during earnings season?
Yeah, there's certainly a. I find that executives are cheerleaders. They're cheerleaders for their companies, and they will always be cheering. Um, so I do try and treat a lot of what they say with skepticism, and I try actually not to talk to management all that much because I'll probably come away with a skewed perception. At least that's what I found for myself. So um, I really like looking through an earnings report where management isn't throwing up a whole bunch of non-GAAP or non-IFRS numbers. That can be a bit of a red flag. By using IFRS numbers and stuff, you're straitjacketing yourself in a certain way, but it also means you're not cherry picking information. But some companies love to just cherry pick information and use really rosy language to look at, say, adjusted EBITDA. And adjusted can mean anything. You can adjust it every quarter if you want. So it can be a fairly meaningless metric. So that's something I look for. Sometimes companies will report after the bell on Friday, which is fine. I think Warren Buffett actually does that, which is a great counterexample. But occasionally companies will do that if they don't want people to pay attention. I don't personally think it works that well because, you know, the next week people will, sure enough, get back to the office and the analyst community will dig into it anyway. But occasionally companies will try and do that. Um, and those are basically the big things I'm looking up for. The really big one is how much are they relying on non-GAAP measures or non-IFRS measures. You can always read through the report and just ignore all the non-GAAP stuff that they're talking about. But occasionally there's a lot of it to ignore, and that's not always a good thing.
Right, those are good things to look for. And just for a little bit of clarification too, for myself and our audience, what is non-GAAP and the IFRS? What does that mean?
Oh, so if you're reporting your earnings, you have to be fairly rigorous and be by the book to do it. So what your 10K, for example, or your annual filing or your MD&A here in Canada, that will it could reference non-GAAP measures, but it will be very rigorous in terms of they will be reporting to a set specific standard. But in their press release and in their presentation to investors, they may use non-GAAP measures all over the place. And some of them are useful, like backlog is useful, and that's not a GAAP measure. And all-in sustaining costs for a mining company, that's useful. It's not a GAAP measure. But an over-reliance on them kind of strikes me as like just throwing a bunch of glitter in the air and hoping the analyst community just focuses on that and bridge on the ground. Um, and that's just kind of what I sometimes see in companies. Certain companies are way worse than others, but all companies, I think, to an extent, do use some non-GAAP or non-IFRS numbers to convey their story to investors.
Okay. You'll test me my knowledge here. This is from way back in the day when I took accounting. So GAAP stands for, is it generally accepted accounting principles? Is that right?
Yeah, yeah,
Okay,
that's right.
got it. It's still up there. I don't know why it's still there, but I somehow
Well, that's
remembered it.
good.
All right. Okay, so I think that answers that. Thank you so much for going through all that stuff. I'm just going to ask the audience, if you are enjoying the show right now, make sure you subscribe to the TD Direct Investing YouTube channel. And if there's a topic that you'd like to learn more about, let us know in the comments. Plus, you can follow us on Instagram at TD_Direct Investing to get a sneak peek at upcoming shows and a ton of other content designed to help build your investing knowledge. All right. So now let's hear. I did say earlier on in the intro, I said we were going to talk about some of the hits and misses. Let's hear about a little bit of those in terms of some of the lessons you've learned. First off, what's the best investment that you've made on the back of a company's earnings report, and what did you learn from
Um, well, a company that I bought in the depths of the pandemic. So in the first quarter of 2020, when no one wanted to own anything, was Bird Construction, and I bought it having looked at its financials at that point in time and concluding it was a good idea. So that was quite important. Since then, the company has done remarkably well, and this year, for example, they have beaten earnings a lot. So I don't know how many quarters they've beaten earnings now, but it's been a number of quarters, and the company's stock chart illustrates how well they've done as a result. So I've actually been paring back my position throughout the year just to take some of my profit off the table and lock in some gains. But I would say, at least for now, that's a big one that is in my mind as a good example of a company that when I bought it, I was buying it because of its earnings, and then when I was selling it, the same thing. Um, and another thing I should actually mention here, and one thing I wish I had done better on this one, it's done very well for us. We've done excellently on it, but I think I could have done better had I incorporated a very material event for them. So they bought a competitor called Stuart Olson at what was essentially a bankrupt price. It wasn't bankruptcy in theory. You still got some money as a shareholder of Stuart Olson, but it was incredibly little. And that was a big material change for Bird to buy such a big competitor at such a low price really drove value over the long run. And I wasn't aware enough of that when I was, say, making my first sale on this about a year ago. But anyway, live and learn. It's been a great one, but there's always room for improvement.
Well, that's very interesting. It can't all be home runs, right? But that's a good example, and yeah, I like that. If you're having some profit, that's great. But on the flip side, what's the worst investment that you've made on the back of a company's earnings report, and what did you learn from that?
Yeah. So the worst one I ever made was really early on in my career. It was in 2011, and it was in a company called Emeticis. And Emeticis is a New York listed company. Actually, it's Nasdaq listed. Anyway, they are in hospice care, so not the prettiest business, not a very nice business, but hospice care is important. Home care is important. Taking care of the elderly and sick is important. So that's what this company does. And I bought it in 2010 because it was so beaten up following the financial crisis. And I thought the demographic trends underpinning this company were wonderful. And that was my assumption. And that was why I bought it. Being so young in the industry and not appreciating some of the features of a balance sheet, I overlooked the importance of the goodwill on that company. And there was so much goodwill. There was a tremendous amount. And in the middle of 2011, they cut their goodwill from like 905 million to 330 million or something like that. So, you just knocked out two-thirds of it. It was a massive hit, and the stock dropped as a result. It dropped in a huge way, and I was hurt from it big time. And it dropped, I think it dropped like 30% pretty much overnight, and then it just kept going down. And eventually I just threw in the towel and quit. So the lessons there are a fewfold because the company then went on this absolutely outstanding rally, and the demographic play, which I thought was in play, transpired. And the stock went up to, I think it was over like, yeah, $300 at one point. Um, so the lessons I think are twofold. One is goodwill can really hurt. And then two is if you have a good thesis, um, the goodwill being knocked out could actually be a time to buy if you don't already own it. And if you do own it, consider taking a loss and buying back in if you want to take a tax loss, or if you own it in like a registered account, maybe just suck it up and keep going because once that goodwill is written off, once the market's really beaten up your shares, if, and it's a big if your thesis is correct, you should do well over the long run. So it was a big lesson. I have made mistakes with write-offs since then, but nothing that big. That was by far the biggest. You'll find write-offs for deferred tax assets, for inventory, for accounts receivable, for intangibles or goodwill. Almost anything can be written down, but goodwill is a big one. I think goodwill is written down more than other assets on the balance sheet. So it's definitely something to be aware of.
All right, that's a great takeaway. Yeah, watch seems like the word of the day is goodwill, so we want to watch for that goodwill. I really like that. All right, Phil, thank you so much for sharing your approach to analyzing stocks during earnings season. We're going to hop into Webroker to show our viewers how they can get their own research started when earnings season does roll around. So we've got a clip that we're going to share, and you guys can check it out. So you're going to start on the research tab, and specifically you're going to go to research and events. So I'm there already. So if we take a look at today's listings for earnings on the 12th of December, we can see we have these 6 companies highlighted on the Canadian market. And then if we jump over to the US market, if I click this flag on the top right hand side, we can see that there's only a handful as well. These are the highlights that are available. It does it on both sides, where you're going to have to click the second tab to see all of the available earnings announcements for this particular day. So once you've done that and you've identified a company, there's another step you can go to. But before I show you that, there is the calendar. You can click on the calendar section because you're usually going to look well ahead of time to see, that particular day, if there's some earnings coming up on a day that you might want to focus on, or you can actually even go to the company calendar by just putting the symbol in right here. So that'll take you to the calendar listing the upcoming earnings for a particular stock. And we want to go to our famous overview page, then what we want to do is click on the actual symbol. So we'll click on Costco, and I'm going to scroll down a little bit. I'm going to, at the very bottom, click on overview, and that's going to take me to a familiar page for most of you. where you have the overview of the stock. We have charts, news, fundamentals, and I'm going to click right now on earnings because obviously that makes sense. We're looking for information about earnings. So once I click there, you can now see that I have the mean estimate, so the actual average in this darker line of, what is the estimate for the earnings per share. That's some important information you can find. You can look at past actuals for the stock so you can see where they came in previously on other quarters. And then it also gives you down below, it's going to give you information on the standard deviation for those that love to figure out the math. It's going to show you that within one standard deviation, what the expected move is within a certain level. And it's going to show you previous mean, low estimate, high estimate, et cetera. So some really good information right on that earnings tab. And then from there, what we're going to do is we're going to actually go to the reports section because there are a number of reports that are available right here. So you can click on these, but I do find the one that's most important in my mind is if we click on the reports tab, you're going to look for the earnings report. So this earnings report is here on the left-hand side. It's from the first call earnings valuation report. So if I click on that and open it up, and you can get a really good detailed insight here as I zoom in a little bit from a visual perspective on earnings that have happened in the past, and it also has projections as well. We can see some of these dots. It may take a little bit of time to get used to this, but you can see these dots show past earnings for previous quarters, and you can see, is there any surprises, or was there a positive surprise or a negative surprise? And then I think the darker circles are more of the, it was in line with the estimate. And you can also overlay this over a chart and see, was there a trend? Did something happen after each one of these earnings where often it may drop and then sometimes it'll come up after the market's had time to digest, or you could see it always drops, or maybe it'll always skyrockets after earnings. You can kind of identify these trends with this particular document. And then scroll down, you're going to have another number of visuals and graphs and diagrams that will help you with your evaluation of earnings for this particular stock. So now once we close that, if you wanted to use a visual on a chart, you can actually go back to the chart tab and you can see how did earnings impact the actual trend on the stock after it was announced. So you have these little earnings icons. The way that we add those is we would go up to the right-hand side here under events. I'm going to click on earnings so I can take that off and I'll add it back on. And now you can look at the chart on whatever time frame you like to look at. If you want to look at year to date, or you could look at longer. If you looked at, say, a 3-year time frame, then you can hover over all of these and get an idea of what happened with earnings on those particular instances. So after that, the other thing I would say you can utilize pretty effectively is you can use the news section. If you go to the news tab, there may be some recent highlights or recent articles or links you can click on that are related to earnings. And after you reviewed that, the last one I'd say you can go to is you can go to events, this events tab. So this is an actual specific to the stock events announcement. And we can now see, what's upcoming in terms of earnings announcements. This is the one for today. We can see past earnings announcements in terms of what was the estimate, and what was the previous year actual in itself. And then we can also see how many analysts are rating the stock from an earnings perspective. All right. So, Philip, we're going to have to leave our interview portion there, but we're not quite done yet. Are you ready to open the floor to questions? So, we're going to get questions from our audience. Are you ready to hear what our audience wants to know about?
I'm ready.
All right, you ready? Perfect. And then one just note to our audience too, is if you haven't noticed it already, I'm sure you did, but if not, this is a live event. Obviously, we can answer. We're going to have Philip answer your questions, so make sure you put those in because we want to keep the questions rolling. We've got quite a few that we can take a look at already, but put your questions into the Q&A box. It should be on the top right-hand side. So enter those in right now, and we'll field those questions in the last little bit. So let's see what I have here already. I do have a question from Luciana saying, what are the sectors and or companies that you think that are going to do great in 2025? Do you have any thoughts on that at all, Philip?
Yeah, so the first thing to say is we found most opportunities this year selling things, which is unfortunate if you're a new investor looking to build out a portfolio. We've had 2 very good years in a row. 2023 was up big double digits, and again this year. So most sectors are quite high right now. Not all of them, but most of them. And since the re-election of Donald Trump, Many sectors that had been lagging have caught up. So at this point, figuring out which sectors are going to do well next year is quite difficult. One thing I might say is instead of looking just at sectors, it might be prudent to look overseas because the valuations in Europe are lower than they are here in North America. And the valuations in other countries like New Zealand, Australia, Japan are lower. And again, in developing markets, China is very beaten up. China is a little different than, say, New Zealand or Europe or something because the accounting standards are fairly rigorous in places like Europe. Whereas China, it's not quite the same, so there is some caution to be had there. Um, but that's something to keep in mind. Another thing is stocks can have I don't know what next year will bring. I genuinely don't. Three up years in a row like this would be quite unusual though. So that is in the back of my mind. That's not to say it won't happen though. The end of the 1990s was like that. And it just went from crazy to even crazier. So yeah, I'm not quite sure which sectors will do well and which ones won't. My guess is that say in the US context and the Canadian context anyway, there will be a rotation at some point out of big tech and out of these magnificent seven into more mundane things like industrials and healthcare. Um, I wouldn't be surprised if that happened at some point. When it will happen, I don't know, but I wouldn't be surprised if that happens at some point.
All right, no, that's some good food for thought. That was a great question. Thanks for sending that in, Luciano. And we have a question from Bob. Bob's asking, what were some mistakes that you personally made in the past when analyzing financial statements?
Yeah, well, we've gone over goodwill, so that's a good one. Occasionally, I've got the debt, just got them wrong, and there are no two ways about it. I invested in some oil and gas companies in 2014, and the debt metrics looked okay, but the revenues kept falling. So it didn't matter that the debt metrics looked okay when I started investing in them because the revenues were falling too fast. So it was a twofold mistake on my part. One is I got the debt metrics one. There was just simply too much debt. And then two was I should have been more patient and waiting for revenues to at least stabilize first. So those were two quite big mistakes. And unfortunately, I didn't make it with one company. I think I invested in three or four oil and gas companies, and most of them had that trend at that time, and it was bad. Three of them, I think, were sold for significant losses, and I would have been way better off had I never done it. So I would say that's another big one. Good.
Yeah, you learned from your mistakes. So I had a great question from Bob. We have another one. I want to get through them as quick as we can. We've got a bit of time left here. I have a question from Frank. Frank is asking, at what point in your research process do you start looking at financial statements? Says, do you need to have an indication the company is worth looking at first before you even bother?
Almost right away. So when I am going through a watch list or when I create a screen, you say it comes up with 50 names or 100 names or something, I will go through all those names um, in an afternoon quite comfortably. And I'll spend a minute or two on each company and I'll quickly look at the stock chart, the valuations. And before I do that, I like to look at the financial statements because usually in my head, as I'm looking at them, I can think, okay, what should the market cap be? And then I can also think, all right, what should the valuations be here? So I'm looking at financials pretty much right off the bat. I think it's very important to do, and it's good to do it and then think about what you would anticipate seeing on the valuation side, given what you just read in the financials. And if there's a disconnect there, that can be interesting. So yeah, right away is the answer to that question.
Okay, that's a great question. So we have another question from, it looks like Kelly. Kelly's asking, in your opinion, what are the easiest and hardest types of companies to analyze?
Um, well, I think everybody is different here. I have found that I am much better understanding banks and financial firms like that versus insurance companies. I find insurance companies much more challenging. They're both in the same field. They're both financials. But for whatever reason, I can wrap my head around a bank and understand what's driving a bank to do well versus what's driving a bank to do poorly much better than I can with an insurance company. Um, and that's just me personally. I know I'm assuming there are a lot of people out there who may find the opposite or who may excel at both. But for me, I'm just not quite as good with insurance companies. And then another one, which is again similar, but for whatever reason, my mind just doesn't meld quite as well, is I'm quite good, or I don't mind assessing mining companies. I'm quite comfortable doing that, and they're an extractive company. But I'm not as good translating that into assessing oil and gas companies. Again, there's just something slightly different about them, which I just find it a little harder for me personally to assess oil and gas companies versus mining companies, which I find kind of funny because at the surface they're fairly similar industries and fairly similar companies. Um, but yeah, so that I hope answers your question, and that's what I personally find.
Well, that was a
Everybody
good
will be
question.
different though.
Yes, yes. Not a one size fits all. Sometimes it could even be maybe your level of interest in that topic too. But I
That's
think you're
true.
right. It's always it definitely varies. So we have another
Yeah.
question from John. So how can you get a sense of whether goodwill is an asset or a hindrance to a company? So I know we've talked a lot about goodwill, but can you answer that question for John?
Oh, that's a multi-million dollar question. That is a difficult one. Something that I like to see is how old is the goodwill? If the goodwill is old, there's a higher chance that it's not a hindrance because it would have been written off already. If the goodwill has been on the balance sheet for a long time, it means that purchase the company made was a good one and they were able to capitalize on it. If it's new goodwill, it should be treated with a bit more skepticism just because we don't know whether it's going to need to be written off or not. So that's one telltale sign, just how old it is. Another one is just how much there is. You don't want to overpay. At the end of the day, you want to pay as little as possible for companies that you acquire, which is why the Bird acquisition of Stuart Olson was so exceptional. They were not overpaying. They were getting it for pennies on the dollar, and that was an outstanding trade for them. So, looking at the amount of goodwill and looking at the age of goodwill should at least start the process of trying to figure out whether the goodwill in question is good or bad.
All right. Great answer, Phil. Thank you so much. We're going to wrap it up there. I'm going to just kind of start to wrap things down, but I had one final question for you. What are your thoughts? Like, what are your overall thoughts for the upcoming earnings season and just stock research in general? Anything you wanted to close off with?
Well, I think the upcoming earnings season, at least for US companies, it'll be the fourth quarter earnings season, which we'll be getting into in the new year. Um, there'll be a lot of talk about changing regulations, changing tariffs, changing labor pool demand based on immigration or kicking people out of the US. And I think a lot of companies will be talking about those factors. A lot of them will be talking about deregulation in the financial space, for example. And then a lot of manufacturing companies may be fretting over tariffs. And then hospitality and healthcare service companies and agricultural companies may be fretting over labor availability. And I think you'll see management teams starting to talk about all of those features in the upcoming quarter, just because the re-election of Trump will be quite a big change economically. So companies will be trying to address those challenges and opportunities, and they'll be trying to update shareholders on how they see the roadmap playing out ahead. So that's what I'm looking for in the quarter ahead. And the same thing is true for Canadian companies. We're going to be potentially on the other side of tariffs. So what that means for our companies will be quite important. So I'd be looking out for that as well.
All right, excellent. Definitely some things to keep an eye on. And another thing to keep an eye on is we do have some upcoming events that are just like these. This one will be on demand. It will be available to watch on demand, and you can check that out in Webroker on our Learning tab. We also have the upcoming events. You can see that. We'll highlight that on the screen for you. We have the upcoming other webinars that you can watch for in the new year and the end of this year. And we also, on the left-hand side, I want to give some props for Phil too, because we do have a ton of resources that you provided on. We have your page on X, we have your YouTube page, the Contra the Herd on YouTube, and we have Philip MacKellar on Seeking Alpha. So there's a ton of great information if you're looking for more there, along with our YouTube page, TD Direct Investing's YouTube page. You can see that down at the bottom, and our Instagram. So if you want to get up to the minute updates about upcoming webinars and other reels that we have that are financially related, check out that information, subscribe, and I think you'll really enjoy what's there. So thanks so much again, Phil. I don't know if I'm going to see you before the end of the year, so Merry Christmas and Happy New Year and all that that fun stuff. Happy holidays.
Happy holidays to you too. Thank you for having me.
Thank you so much. And thanks to our audience for all those great questions, everybody. Check out, as I said, check out what we have upcoming if you enjoyed this session. And there is a survey, so let us know how we did today, and let us know if there's any topics that you'd like to see going forward. So if you can fill that in, that would be greatly appreciated. We'll highlight that on the screen where that is. It's just down on the bottom as well, if you didn't get a chance to click that yet. But thanks so much, everyone. Have a great day. Keep learning, and we'll see you next time.
Have more questions? Check out the links to the right and in the description below.